Hey everybody, Josh Sigurdson of World Alternative Media here, and we're joined once again by Mark Gonzales over at First National Bullion, and we have something that we have not seen since the global financial crisis. In fact, it breaks those records. This is out of Zero Hedge. Goldman says adjustable rate mortgages climb to 41% of total held by U.S. banks, surpassing global financial crisis records. When we check out here on the dailydoom.com, horrible name considering we're just trying to give people solutions, but nonetheless, it says Goldman Sachs reported today that adjustable rate mortgages, ARMs, have climbed to record levels, beating their highest mark in 2008. Proving that we learned absolutely nothing, as usual, even from our worst economic mistakes. 41% of the mortgages now held by U.S. banks are ARMs. So this is very concerning. For those of you that have no idea what this means and how this affects you, we're going to go into that right away with Mark. But before we do, I urge you to check that link below, firstnationalbullion.com/schedule-consult/. It has to be that exact link. It is in the description, of course. And there you could avoid the coming digital system, avoid the financial crisis. And there you could buy physical gold, silver, platinum, or palladium. You could hold that gold in your hands, put it in a vault, put it in an IRA outside of the traditional IRA system, and schedule an appointment for a free consultation with Mark Gonzales, as well as get a complimentary investors package. Just let him know in the comments of the form when you sign up that you found him at World Alternative Media or WAM, WAM. All right, let's get into this. So we have another record-breaking story, Mark. We have had a lot of those lately, to be fair, but they are all pointing in the same direction. We are reaching that breaking point, and people are, getting pissed on, and they think it's rain. I mean, we need to understand this. Can you break down what this story means and what this 41 percentile record-breaking number means?
Well, it means that we're heading in the wrong direction, and I find it very interesting that, about every 8 to 12 years, this cycle of expansion and contraction for defaults and bankruptcies to set in, and the financial institutions that lend you the money, they get it back. So nothing's ever changed. So the reason that we're seeing things going up in arms is, one, interest rates are high. People aren't qualifying to refinance their homes, but they're needing to pull cash out. Hopefully they do something productive with it, and they're not doing it to finance a vacation, because that's just a stupid thing to do. But a lot of these are going on HELOCs. A lot of them are for new first-time buyers who actually qualify into getting a purchase. Now, with adjustable rate mortgages, how those work is, if you don't have one or you never have one, is you have some sort of index that's tied to a margin. So the bank sets the margin. The margin is based upon your credit tier and your debt to income. And with, just like the previous video we did with John Williams, just over 10% is actually where inflation's at. It's hard for people to qualify, right? They got too many credit card payments. They already have a first. They maybe already have a second. They're getting a third. They have 2 to 3 car payments. All these things add up, and you got to qualify within a certain matrix of about 40 to 50% of your debt obligations versus your monthly income. And with adjustable rate mortgages, you have that margin that's set by the financial institution, and it could be 2%, it could be 3%, it could be 5%. You add that to the index that it's tied to, and that is either going to be the prime, which is 4.5. It's going to be the LIBOR. Don't know what the LIBOR is today, or the coffee. I haven't followed that in a while, but the coffee index is the blended average index for California, Arizona, and Nevada. So if your margin's 5% and prime's at 4, your interest rate's 9. But a lot of the times you have an introductory rate or a start rate that could be good for 6 months to 12 months. And that is what you're qualifying on. And that could be like a teaser margin, kind of like a 0% interest rate credit card that you have an opportunity to pay it down if you wanted to. Most people don't. So instead of a 9% interest rate, you could be looking at, like a 0% margin or a 2% margin. So now you've got a 4 to a 6% interest rate, kind of a teaser, and that's what qualified you. But guess what? That loan is going to adjust. It's going to adjust to the actual margin and the actual index, thus doubling or near doubling your interest rate. And a lot of these payments have an interest only payment option. That gets it really hurts people, because you're used to paying just the interest, but when that interest balloons to a certain percentage, and you're not paying down that principal, there comes a point where they call it due. Say, no, you can no longer afford that interest payment. So if your interest payment, let's say $1,500, it's immediately going to like $2,500. Another thing that I just recently found out regarding the mortgage industry, which scares the living hell out of me. I don't know if anybody remembers the ninja loans, the no income, no asset loans. If your credit score is high enough, I do. I owned a mortgage company at one time. And that was a big product that almost everybody in the industry was selling. But if you have a high enough credit score, they're not going to look at your income. They're not going to look at your assets. It's just kind of take your word for it. So when you see these things becoming offered and they're dominating the balance sheets, it's primarily what is being sold. One, adjustable rate mortgages, huge moneymaker, because not only is the financial institution carrying the entire margin. If the margin is 5%, they got 5% of that loan month in, month out. It's coming to them. But also when they sell it, it's a higher yielding loan. Loan officers get paid more on them. There's generally a bigger incentive or yield spread on the back end to a loan officer to actually make that deal. So that is kind of what they're going to persuade you to buy, kind of like a financial advisor is going to advise you to the stock of the day. But hey, fuck gold. The reason they do that is because if they sell you $100,000 in gold, they're going to make a commission one time on that transaction. You don't pull people in and out of the market, theoretically, with gold. You can with the shares of ETFs and miners, but that is why they do it. It's just, it's dead money to them. So, all right. Someone knew before the collapse of 2008 that we are headed down a very, very dark path. You cannot tell me that the hires up of these financial institutions did not know the bullshit that they were promoting and how toxic it was going to be for the financial environment. Someone knew, but they kept promoting it out because why? They're squeezing all the blood from the stone, knowing things are going to turn and they want to capitalize on it. Fuck. Even towards the end of the run of the mortgage boom going into 2008, I remember vividly there was a company called Chevy Chase Bank. And I remember that because, I like the name. I like his movies. And they had a payment option arm where you could have a negative below your standard interest rates. You could pay the minimal payment and it would add on the delta, the difference of what you should have had to pay to just cover at least the interest onto your loan balance. And when the loan balance reached a level of 110% of the original loan, you no longer had the start rate, but you would qualify at a 0.25% start rate.
Yeah.
A 0.25% interest rate start rate. Anybody would, and they would do this loan up to $7 million.
Mark, I have to step in for a second here because, I've done a lot of videos on the housing market in the past, and we've seen it's a localized issue, of course, but across the board, we see similar things happening that we saw in 2008, 2007, where, at the end point, they knew what was going to happen with the credit default swaps and the collateralized debt obligations. They knew that putting a bunch of, C-rated or D-rated homes collateralized with a bunch of, AAA, a couple AAA homes, say 5%, putting them all together and then rating them all AAA across the board was going to be a problem. They knew this as they were trying to get anyone possible to get in and get a loan and get a mortgage and buy a house that at rates that were crazy. I think that we are witnessing the same thing right now. But of course, we also know that there is an agenda overall to essentially push people out of their homes. You will own nothing. BlackRock has taken over the housing industry, and they're bringing in digital IDs as we see a tidal wave that seems to be approaching. A lot of these some of these markets were bubbled 15 years ago and continue to be bubbled out of control. They built ghost cities in some places in the United States today, not at the rate that China does, but nonetheless, they do this. And you have to wonder, how long can the bubbles withstand bursting? And the fact that it's lasted this long is beyond comprehension. It's never in history been pushed on as long as it has, as we've seen in the last 10, 15 years. If you look at Toronto, if you look at Vancouver, if you look at New York, if you look at LA, if you look at Seattle, if you look at places like Dallas, even, it's like, how could this possibly be happening and be pushed off this long? And when you see the banks get predatory like this and try and get people in at any cost, and these ninja loans that Mark was just talking about, I mean, there's something happening here, and we're on the verge of unfortunately seeing something that we've seen before, but on steroids. What do you think is the how do you think this housing market overall looks like in the United States right now, and going into all this? It looks like this is a sign of the times that we saw before.
Oh yeah. Well, September, you got a rate cut already baked into the data, and if the Fed overshoots, then you're going to get a joyous move in markets, especially gold and silver. Um, honestly, I see signs of the housing bubble already starting to bust. You have many of the locations where people have been moving to go to Arizona, go to Florida, go to Texas. Their property values are already rolling over, and in fact, many of them are down anywhere from 20 to 30% year over year. This scales in size. Um, Ultimately, this bubble bursts when it's allowed to fail. It's being artificially propped up, and it has been since 2008. And you could actually say, if the terminology of being in a depression is depressed growth, and we've been experiencing depressed growth because we papered over the financial woes of the 2008 collapse, which again was engineered: expansion, contraction. You go broke. I'm the bank. I get your house, the car, the boat, the business. You're left to start over. Sorry. Thanks for playing. So we are technically in a depression, even though no one's going to call it that. But it's when all these funding sources and all this manipulation to keep the system joyous and moving forward. Some things that I'll mention that we've done videos on, some things that we haven't done videos on, just real quick. We can see that we're getting close to this revaluation on many different fronts. One, government going to be switching to AI per Elon Musk, per Doge, which was an audit to find out the financial situation of the U.S. government actually to go into the bankruptcy. That's my thought. You got the Fed already talking about yield curve controls. If they do that, they want to keep the rates at, let's say, 2.5%, but they're the guaranteed buyer. That means inflation. We are now at the cusp, if they do that, on the verge of a potential hyperinflation. That is now on the table. You got a potential gold revaluation, and you have all the metal that has been delivered over the last 3 months in the gold and the silver market just coming on the COMEX. It's like increasingly more every single month, and it's nosebleed levels. So you have all these reasons, and now you got the stable coin, which is going to be a 1-to-1 back from Treasury. But who's to say that they don't go from a 1-to-1 backing to a 20-to-1 backing, giving you the utility of 5 cents for every dollar you have? This is what a currency valuation looks like, people. And a lot of people are looking at gold, and I actually had this conversation with a client today. She wanted my honest feeling, like, should I buy gold at 34.50? And I'm like, yeah, fuck yeah. Why? And I gave her the example that I've talked about before. Okay, so let's go back to Venezuela in 2017 to 2018. And the gold in the Bolivar went from 11,000 to about 17,000. And a lot of people sold because they thought, okay, hasn't been here in a while, and I've been waiting 8 years. So let's get out and hedge ourselves. And then a lot of people looked at the price and said, I'm not going to buy because it just seems too high. Okay. Gold and silver are money. They will always keep track of the devaluation. And in this case, not only did they keep track of it, but they overshoot. So if you go 5 months past that rise from 11,000 to 17,000 Bolivar, the cost of living through the hyperinflation default of Venezuela went 5,000 times higher, 5,000x. Okay. A cup of coffee was more than what people actually made in a month. Now, does that come to the US? I don't know, but it's definitely on the table. The fact of the matter is people that shied away from precious metals, from gold, because 17,000 Bolivar, they thought that was too high, so they didn't buy, or they sold out of their position. Guess what? Cost of living went 5,000x, gold went 25,000x. So not only did you keep par with inflation, gold went 5x higher. Yeah. Okay, so you want to preserve wealth, you want to grow, you want to take advantage of the opportunities in this reprice, which is clearly coming. Yeah. You need to get precious metals. And then if you look at the gold chart, we'll do another video on this in the future. If you guys want us to, let us know. Gold is coming out of a pennant breakout. The breakout point is right around the 34.30, 34.50 range. We're breaking out of that, and it has been a convincing chart pattern 4 times in the last 10 months. Each one incrementally when it broke out, the percentage of gain. So if this follows the same suit that it did in the breakout just 4 months ago with the last pennant tag, you could honestly see $3,600 gold in a very, very short order. This is going to cause momentum. And with people understanding the reality of losing the value due to inflation, and it just excels and excels. Eventually, the person that's lying to you, trying to talk sweet and make you feel good, you're going to call bullshit. Yeah. But unfortunately, by the time that happens and most people wake up, you're looking at 36, 37, 4,000, even higher gold. If we have a gold revision, it's going to cost you even more. If everybody decides to jump into the gold market in scope is very, very, very small compared to most markets. Silver is even smaller. In my career, I've actually seen delivery delays up to 6 months.
Yeah.
And I've seen premiums shoot astronomically high above percentage wise where they are now. So make it easy on yourself. Don't let life make the decision for yourself. The telltale signs of where balance sheets of banks are going to go when they already have such a piss poor balance sheet reserve of many about 1%. They're supposed to hold more than that, but only about 1%. So they only get a chance to get it wrong this much.
Yeah.
And once we start to get this collapse and things in stars align, and this is no longer a funded rig game, they're going to let it fall. It's not going to happen, in my opinion, before the digital framework in the U.S. and majority of all Western countries is actually enacted. That comes this year. So we're right in line for a standard revaluation.
Oh, absolutely. And yeah, the banks are totally bankrupt, not just the derivative exposures, but yeah, the cash deposit ratios are minimal. And by the way, Mark mentioned Venezuela before, and of course, the Bolivar Fuerte, which, if you know Spanish, fuerte is Spanish for strong, not very strong. They'll tell you that, again, it's raining when you're being pissed on. This is an average thing that you see at the collapse of an empire. They will tell you everything's strong. Don't worry. And what we're seeing with the dollar, yeah, we're probably not going to see the same thing as Venezuela, because Venezuela is an emerging economy, and of course the massive amount of inflation we're going to see at a different rate. But it's apples and oranges when we're talking about something like Venezuela with thousands of percent inflation. Okay, so the United States gets what? Hundreds of percent, maybe a couple $1,000% inflation, and when it collapses, it will be worth nothing. So eventually, infinity. But what it's apples and oranges. At the end of the day, gold and silver are an inflation hedge. So regardless of the price right now of it, it's about what it's going to be versus the dollar later on, which of course eventually you won't be using. So don't store it under your mattress. Don't just trust. First of all, don't trust your bankrupt bank, which has policies in place that they could literally take your money and it's not insured because the FDIC is bankrupt in itself. Don't trust your banks to hold something that is worthless in the first place, eventually will be worth nothing. All fiat currencies eventually revert to their true value of zero, always have, always will, since 1024 AD in China. And add on top of that the housing market situation, and add on top of that push to that digital system. Do not be caught in the middle of this, and find that wealth insurance as solace in the face of these crises. Again, we have that link for Mark in the description of our video that I urge people to go and check out. That's firstnationalbullion.com/schedule-consult/. It has to be that exact link. And again, there you can find shelter from the coming storm. And it's not about doom and gloom. It's about having a real solution in front of you that stops you from succumbing to the coming crisis. So this is a positive thing, a very positive thing for you going forward, that makes you feel good going forward and makes you sleep at night. And again, you want to be able to sleep well in the face of what's happening today, because I don't know if you noticed, but the news is crazy. They're at that link in the description. If you use that exact link, you'll find gold, silver, platinum, or palladium. You could hold that gold or silver in your hand, put it in a vault, put it in an IRA outside of the traditional IRA system, and schedule an appointment for a free consultation with Mark Gonzales and a complimentary investors package there. Highly recommend people go and check this out, and let him know in the comments of the forum that he found him at World Alternative Media, or WAM, WAM. Again, this is your opportunity to take that next step so that you don't have to worry so much. You don't have to stress out, feel the depression of the coming depression. No pun intended. That was a terrible play on words. The point is, you don't want to be sitting there worried all the time when you guys could actually have a solution at your fingertips and pull out of that system as much as you can. And again, breathe a sigh of relief when you know you're not going to be caught in the middle of everything that is about to happen, which, again, all the historical indicators point to, yes, we are entering into a major crisis, and the banks are showing it just by their own actions, what they are doing. And of course, the way they're preparing. Well, if they're preparing, we should be preparing too. So again, thank you, Mark, for everything that you've gone into here today. Very insightful as always. And until next time, my friends, we'll be back with much more videos. Check that link in the description. This is Josh Sigurdson and Mark Gonzales signing out from World Alternative Media. Find the truth. Be the change.